If you've had a vehicle repossessed, I want you to hear something first. You are not alone. Repossessions happen to real people in real situations. Job losses, medical emergencies, divorces. Life happens. And a repossession doesn't have to be the end of your ability to get financed for a vehicle, but it does change things. And understanding exactly how it changes things and what you can do about it is what this video is about. I'm Gary, the bad credit car guy, 26 years as a general manager of an independent used car dealership. I've approved post-repo deals. I've also declined them. In this video, I'm going to tell you exactly what a repossession does to your credit, how lenders look at it, and the specific steps you need to take to get financed again. Let me start with what actually happens when a vehicle is repossessed and how it shows up on your credit report. When you miss payments on a car loan, the lender has the legal right to repossess the vehicle. Once they take the vehicle, they typically sell it at auction. Whatever they get for the vehicle at auction gets applied to your remaining loan balance. Here's where it gets complicated. If the auction price doesn't cover what you still owed on the loan, and it often doesn't, you still owe the difference. That remaining balance is called a deficiency balance. And that deficiency balance can be sent to collections, which creates a second negative item on your credit report on top of the repossession itself. So on your credit report, a repossession typically shows up as two things. First, the original auto loan account showing as charged off or repossessed with all the late payments leading up to the repo. And second, potentially a collection account for the deficiency balance if you didn't pay it. Both of those items hurt your score, and both of them stay on your credit report. Here's the question I hear most often from people who've had a repo. How long is this going to stay on my credit report? The answer is 7 years from the date of first delinquency. The date of first delinquency is the date you first missed a payment on that loan, not the date the vehicle was actually repossessed. Those two dates can be different, and the date of first delinquency is what the clock starts from. So if you first missed a payment in January 2021 and the vehicle was repossessed in June 2021, the 7-year clock started in January 2021, not June 2021. After 7 years, the repossession must be removed from your credit report by law. If it's still showing after 7 years from the date of first delinquency, you have the right to dispute it and have it removed. Now, here's something important about that 7-year timeline. The impact of a repossession on your score diminishes over time. A repo from 6 months ago hits your score much harder than a repo from 4 years ago. Lenders also look at recency. A 2-year-old repo with clean recent payment history tells a very different story than a 6-month-old repo with nothing positive since. Time is your friend after a repo, but you don't have to just sit and wait. There are specific things you can do to speed up your recovery. Let me tell you exactly how subprime lenders look at a repossession, because it's more nuanced than most people think. First, lenders look at how recent the repo is. A repossession in the last 12 months is a very serious red flag for most subprime lenders. Some lenders won't touch a deal with a repo that's recent at all. Others will, but they want a significant down payment and very strong income to compensate. A repossession that's 12 to 24 months old is still a challenge, but it's workable with the right lender and the right deal structure. Beyond 24 months, especially with clean recent payment history, most subprime lenders will look past it and focus more on what you've done since. Second, lenders look at whether the deficiency balance was paid. If you owed a deficiency balance after your repo and you paid it, that tells a lender something positive about you. It shows you took responsibility even after things went wrong. If the deficiency is still open and unpaid, some lenders will require it to be paid or settled as a condition of your new loan approval. Third, lenders look at what caused the repo and what's changed since. This is where your finance manager becomes critically important. A good finance manager can tell your story to the right lender. Here's what happened. Here's what changed. Here's why this customer is a different risk today than they were when the repo happened. That context matters. Fourth, lenders look at your credit activity since the repo. Have you opened any new accounts? Have you made on-time payments? Is there anything positive on your bureau since the repossession? Even small positive items. A secured credit card paid on time, a personal loan with no lates, show the lender that you're rebuilding. Now let's talk about what you actually need to get financed after a repossession. Here's what subprime lenders are going to want to see. Strong down payment. This is the single most important factor in a post-repo deal. Lenders want to see skin in the game. and they want enough equity in the deal that if things go wrong again, they're protected. After a repo, you should expect to need 20% down at minimum. On some deals and with some lenders, you may need more. Save as much as you possibly can before you start shopping. Stable income. Lenders want to see that you have consistent documented income that can support the monthly payment. Have your 2 most recent pay stubs ready. If your income situation has improved since the repo, more stable job, higher income, that's a positive story your finance manager can tell. Time since the repo. The longer it's been since the repo, the better your position. If your repo is very recent, less than 6 months, you may want to wait a few more months and focus on rebuilding before you go car shopping. If it's been 12 months or more and you've had some positive payment activity since, you're in a much more workable position. Clean recent payment history. If you have any accounts that have been paid on time since the repo, put those front and center. A secured credit card, a personal loan, rent payments reported to the bureaus. Anything that shows positive payment behavior since the repo helps your case. A modest vehicle. After a repo is not the time to finance a $15,000 vehicle if a $9,000 vehicle will meet your needs. A lower loan amount means less risk for the lender and a more manageable payment for you. Keep the vehicle price realistic for your situation. Honest disclosure. Tell your finance manager about the repo up front, before they pull your credit. Don't make them discover it. A finance manager who knows about the repo going in can choose the right lender and frame the deal correctly. A finance manager who finds out after submission has a much harder job. Whether you're ready to buy right now or you need a few more months to prepare, here's the exact roadmap for rebuilding after a repossession. Step 1. Deal with the deficiency balance. Find out if you have an outstanding deficiency balance from the repo. Call the original lender or check your credit report. If there's a balance owed, contact them about settling it. Many lenders will settle a deficiency balance for less than the full amount. Getting this resolved, even at a reduced amount, removes a negative item and shows future lenders you dealt with the situation. Step 2. Open a secured credit card. A secured credit card requires a cash deposit that becomes your credit limit. Use it for small purchases, gas, groceries, and pay it off in full every month. This creates positive payment history on your bureau. After 6 to 12 months of on-time payments, you'll start to see your score move. Step 3. Become an authorized user on someone else's account. If you have a family member or close friend with a credit card in good standing, ask them to add you as an authorized user. Their positive payment history on that card gets added to your credit report. You don't even need to use the card. This is one of the fastest ways to add positive history to your bureau. Step 4. Check your credit report for errors. Pull your free report at annualcreditreport.com and make sure the repo is reporting accurately. Check the date of first delinquency. Check the balance. Check that the same account isn't showing up twice. Errors on repo accounts are common and fixing them can improve your score. Step 5. Save your down payment. While you're rebuilding your credit, save aggressively for your down payment. Every dollar you save is a dollar that improves your approval odds when you're ready to buy. Set a target of at least 20% of the vehicle price you're planning to buy. Step 6. When you're ready, find the right lender. Not every subprime lender works with post-repo buyers. Your finance manager needs to know about the repo up front so they can go directly to lenders who specialize in post-repo financing rather than wasting hard inquiries on lenders who won't touch it. Repossession is a serious credit event, but it is not a permanent barrier to getting financed for a vehicle. I've closed post-repo deals. I've watched customers come back 2 years after a repo with a solid down payment and clean recent history and drive off the lot in a vehicle that fits their life. The path forward is clear. Deal with the deficiency. Build positive history. Save your down payment. Find the right dealer and lender. Give it time. I'm Gary, the bad credit card guy, 26 years in this business. I've seen this situation from every angle, and what I know for certain is that people recover from repossessions every single day. Grab the free guide in the description, The 7 Things Dealers Check Beyond Your Credit Score. It covers exactly what lenders are looking at when they review your deal. Subscribe so you don't miss the next video. Drop your questions in the comments. I read every one. I'll see you in the next one.